Headline number comes in as expected, hot, at up 1.2%, up 1.2%. That means that's the highest month-over-month inflation rate since 2005. If we strip out the all-important food and energy, it's up 0.3, about half what we expected, and well below the high water mark, which was April, and April was up 0.9%. That was the highest in 41 years. So we definitely eased back. Now let's go to the year-over-year numbers. 8.5%, usurped 7.9%. 8.5% remains a 41-year high. You have to go back to 1981. And finally, we're looking at year-over-year core, expected up 6.6, comes in at 6.5, taking out the 6.4%. So up at 6.5, we are now looking once again to comp back to 82. That remains the same. With respect to comping, and the reason is because in 82, we traded all the way up to 9.1%. So you could see that 6.5 has some room to continue to go back to the same point 4 decades plus, and that really is the issue here, isn't it? Now, when we adjust earnings for inflation, if you look at hourly earnings on a year-over-year basis, they're down 2.7%. Adjusted for inflation on weekly year-over-year earnings, down 3.6%. And this is really something to pay attention to. We're all together for the last big jobs report. We saw the very historic year-over-year wage gains at 6%, best since record keeping in 97. But we can see that it doesn't keep up with inflation. So these numbers outside of month-over-month core are all hot. They're all cycle highs, something to pay attention to. We know that the Federal Reserve definitely went onto the shoulder of the road, thinking that inflation would be moderating. And, of course, Leo Brannard will be addressing some of these very issues. Their long-term models still say it's going back to 2%, and maybe the change will come down to 2% at some point. But the gains and where we stick on the board is going to remain higher than it was, and that's really what the middle class and most people in America understand. Joe, back to you.
Why the moves?
Yeah, that's what Steve. So you said that they're pretty good at getting these right. So I'm not implying there was either you or Steve, Rick. I'm not implying there was a whisper number of something even worse than what we're seeing. So that's probably not what we're seeing. They weren't expecting worse. But maybe when you back out energy and food, is there some moderation in some of the other things that we're watching, Steve? Why do you think the market reacted positively, and why did the 10-year drop down to 1.72?
Maybe because it wasn't worse than expected. I think you're right, Joe. Maybe there was some whisper number. And that could come from the idea that, look, from the initial commodity price into consumer prices, there's a time lag, and a lot of stuff goes on. You don't know, by the way, there could be some producers out there and companies, Joe, something to watch out for in all these CEO interviews that we do here is there profit margin pressure? Do they absorb some of that and not pass it along to the consumer? But, I mean, these numbers were pretty much spot on in terms of where the street or the forecasters were expecting, a touch hotter, but inside the core, Joe, 6.5%. A couple areas, energy up 11%. Food up 1%. It doesn't sound like a lot, but that's a lot. You're 8.8% on food year over year. That's huge. The only thing that was decent in there, and Rick should care a lot about this. Rick, your used car prices were down. I'm going to double check this number. 3.8%. Was I right about that? Yes. They're still up 35% on the year, so don't get too excited, my friend. But at least for this month, they were down. New vehicles up 0.2, and we had that interview that Phil brought us earlier today suggesting that he doesn't think from Toyota that there's much relief coming in new vehicle prices. Rick?
Yeah, I think that's a very important point, just on the conceptualization that we are seeing certain areas like used car prices come down a bit. But in the near term, when you compare that to how much they originally went up, it's the same thing that the government's saying, well, wow, look at how much we reversed the national debt or the deficit. Same thing, okay? When you have giant spikes, small drops may look like something large until you compare them to the actual move. But I have something, Joe, you asked a good question. You know, Joe, I traded a lot back in the day. And let's say you shorted bonds expecting inflation numbers to be hot, hot, hot. And they were hot. Okay, so you see you're right, and all of a sudden you don't see yields spiking. It's what we call the mogul. It was the nervousness in the positions before the numbers. Now those people that had the right positions are trying to finesse their way out of those positions. When that all clears the zone, I fully suspect you might see some upward pressure again. But yes, fear going into big numbers, whether it's jobs report or inflation data, or even Federal Reserve meetings, usually see interest rates sometimes peak right before the event occurs.